These companies are just hemorrhaging money on this trade. There is a building on fire, and the only way out is through a door that makes the fire worse. This phenomenon right here is called the short squeeze. Hi everybody, welcome to The Art of Speculation. I am your host Orion, and in this episode, we are taking a look back at the most storied stock of 2021. A floundering brick and mortar retailer swarmed, and I mean swarmed, by hordes upon hordes of vampiric hedge fund short sellers on the very brink of a very blockbuster video-esque bankruptcy, pulled off a miraculous turnaround on a dime and generated 100x returns for its shareholders. A remarkable story, the story of 2021. And in this episode, we're going to take a look back at how it happened and cover some of the key conditions that made this story possible. Along the way, I'd like to explain three key things. First, what is short selling? Second, what is short interest? And lastly, and this one's the really interesting part, how it's possible in our markets today to short more shares than even exist. It's quite remarkable, so let's take a look. It all started on March 9th when the Dow Jones fell more than 2,000 points, setting a new record for a single daily loss. Now, a lot of people don't remember that record because it lasted just 3 days, as the Dow Jones then set another record for a single day loss on March 12th, and again on March 16th, losing almost 3,000 points that day. In fact, if you look at the 10 worst single days for the Dow Jones, 8 out of 10 of them belong to February and March of 2020. It is hard to understate just how bad things were in the start of March 2020. But with lockdowns in place almost across the globe, people's daily spending routines were broken. No more paying for commutes to work, no more morning coffees or food court lunches, you name it. Something was happening where people tended to have more time and money available, and dabbling in the stock market suddenly took off as the new in vogue. Okay, quick time out here because reflecting back, I don't think I emphasized this point enough. As you'll see shortly, this influx of retail investors is actually vital to the early price increases in GME. So in a little bit, when you hear me talking about GME going to $8 to $11, you name it, a lot of that is driven on the back of the influx of these retail investors. The scale of this influx hadn't been seen maybe ever before in online investing. If you're enjoying the content, like and subscribe, and let's get back to the hobby. But with all of these new investors starting to invest for the first time, like, what do you invest in? There's just so many stocks. Do I, go plain Jane and buy an ETF? I've heard that's good. Do I do something else? Like, now that I've started to invest and I've got money in the account, what do I buy? And an online Reddit forum called WallStreetBets, for a lot of people, had some answers to that question. Now, without going into too much detail about what WallStreetBets is and where it came from, it's an online Reddit forum that's known for hyper-aggressive trading strategies revolving around highly speculative option trades, though it does a lot more than that. That's just kind of its brand reputation at the time. Now, one stock that was making the rounds on this forum at that time was GameStop. Now, remember, at the time, GameStop was a beleaguered brick and mortar retailer of video games, and they were in the midst of a global pandemic where people who wanted to buy the games couldn't go to the brick and mortar stores that were losing money to sell them the video games. It seemed like a terrible business with a one-way ticket to bankruptcy. The case was compelling. It was really, really compelling. So by June, with losses mounting, financial performance floundering, and the stock price beaten down to $4 a share, a lot of Wall Street firms, sharks, vampires, whatever you want to call them, saw easy money to be made. And I mean, a lot of people saw this opportunity. I'll get to that in a moment, but first, let's take a quick look at what short selling is. Short selling is a way to profit from a stock price going down. And with their belief in the inevitability of the bankruptcy upcoming for GameStop, this was a fantastic way to monetize that thesis, for them to make money by being right. Like all profitable trades, when you're short selling, the same principles apply. You want to buy low and sell high, but you do it in reverse order. And no, you don't need to own the shares to sell them. It may sound odd at first, but it's actually quite intuitive. You short sell cash all the time. And by that I mean you simply spend it before you have it. And when you do, your bank account simply shows a negative balance, letting you know that you have to put that much money back into the account to pay it back. It's the same thing when you short sell a stock, except instead of showing a negative cash balance, it shows a negative share balance. You don't owe a certain amount of cash. You owe a certain number of shares. And to get even, you need to replace those shares, regardless of how much they're trading for in the market. And that is key for short selling. Let's look at an example of what hedge funds and Wall Street pros thought their trade was going to look like when it came to GameStop. Confident that the stock price was going to go down, you can imagine their excitement and dreams of big bonus checks in their eyes when the stock price popped up to $5 a share briefly. Let's say at that moment they saw an opportunity and decided to short 1 million shares of GameStop. When they short these shares, two main things happen. First, their account shows a negative balance of 1 million GME shares. And two, the cash balance of their account goes up by $5 million. But that money they can't touch. It goes into this thing called a short account and is used as collateral to make sure that they end up giving the shares back. So now, the company in our example is short 1 million shares of GME at $5 a share, and boy oh boy, are they excited. Now let's just imagine for a moment this trade went smoothly for them. The stock price drops back to $4, then to $3, then to $2, then $1. So they close their trade by buying back 1 million shares of GME at 50 cents. And when they do, two things again are gonna happen. First of all, the balance of GME shares increases by 1 million, offsetting the negative million position, and their cash balance decreases by $500,000. That's 1 million shares times 50 cents, $500,000. That's what they had to pay. And notice there's now this balance of $4.5 million still in their short account. Well, that they get to keep, and that is their profit for being right on this trade. So that is short selling in a nutshell. And while that sounds deceptively similar to a normal trade, it is way riskier for two reasons. The first reason is you're borrowing. And borrowing to make a high-risk trade, which is like borrowing from Teddy KGB in Rounders. Never let that guy get a hold of you. And the second reason is because there's no limit to the amount you can lose. When you buy a stock, the worst that can happen is it goes to zero. But as bad as zero is, it's actually a safety net, there to catch you when the trade doesn't go your way. But when you short a stock and your risk is to the upside, there is no limit to how high a stock's price can go. There is no safety net. So let's look again at the GME trade, except instead of looking at how they wanted the trade to turn out, let's look at how it really turned out. July. It's all good. Stock comes down to $4 a share and they're well on their way to securing their bonus checks. Man, they're already up $1 million. But then August rolls around and the stock bumps back up to $5. Not great, but not so bad. We're back to being even, but this thing has alligator blood. And in September, things get worse. The stock bumps to $8 a share. But come on, in their mind, this is a mere setback. This company is in a death spiral to zero. Hold the line. And then just as the market seems to be getting rational again, boom, it flies up to $11 a share. This is really bad. This is really bad. They would now have to spend $11 million to buy back the million shares that they sold for just $5 million, meaning they're down $6 million right now on a trade that could only have made them $5 million, i.e. had the stock gone to zero. But these are Wall Street professionals. They know that the market is being irrational, except by October, it was getting even worse. The stock was now $15 a share. Now, if it wasn't bad enough that they were down $10 million on a trade that could have only earned them $5 million, it's worth noting that to close this trade, they have to buy 1 million shares. Now, at this time, GameStop is only trading, call it 5 million shares a day. That order is going to push the price up on themselves, pushing it even higher. But these guys are professionals. They know what they're doing. Situation is under control. And now that they're hearing all their Wall Street buddies laughing at the price of the shares and how this is a no-brainer short, other Wall Street companies are jumping in and shorting at $15 a share because they know that this thing's going to zero and bankrupt any day now as well. And so these pros don't cut their losses. They double down. Let's short another 1 million shares for $15 a share. Two things happen. The balance of GME in their account goes from -1 million to -2 million. And the cash balance in the short account now goes from 5 million to 20 million. And so they are short 2 million shares, ready for the imminent plunge to zero. And by November, sober minds have begun to prevail. And the price of GME is ground back down to $11. And our little hedge fund is almost out of the hole, down just $2 million when the unthinkable happens. More retail investors pile in and push the price back to $17. And memes of GME going to the moon start going viral, escaping just the boundaries of WallStreetBets and the Reddit community, making their way onto Facebook, making their way onto CNBC and other financial news outlets. And not in a small way, but in a big way. And by December, the price of GME breaches $20 before being pushed back to $17. To many Wall Street veterans, the current price of this security is so disjoint from any semblance of rational value that firms across Wall Street are just jumping into this short, piling on, waiting for this thing to come back down to earth. Then, on January 13th, 2021, GME surges another 50%, breaching $40 a share before settling the day a little bit over $30. This is just unthinkable. And the very next day, January 14th, it gets even uglier for the shorts, and GME surges again, breaking $40 a share, but this time holding strong. But this isn't actually the reason I bring up January 14th. The reason January 14th is actually important is because it is the day where the short interest on GameStop, GME, peaked. Short interest is expressed as a percentage, and what it measures is the percent of shares short relative to all the shares available to trade. So let's say there was a company out there that had 1,000 shares in circulation and a total 100 shares sold short. Its short interest would be 10%. That's 100 shares short divided by 1,000 shares in circulation. Now, our mythical hedge fund wasn't the only firm shorting GME. Remember, for the past weeks and months, there were Wall Street firms piling into this short trade. And on January 14th, the short interest peaked at over 130%. Now that means there are more shares short than are actually available in circulation to trade. How is this even possible? How can you have 1.3 shares short for every share there is in circulation? This doesn't make any sense. Or does it? You see, understanding the mechanics of short selling is actually important here. In order to short, you need to borrow your shares from somebody else. Let's say you borrow 100 shares from them. Now, you have their 100 shares and you sell it short into the market. Now, the brokerage doesn't remove their shares from them. They continue to have 100 shares and you have minus 100 shares. So overall, the math makes sense. But for you to sell your shares, someone else had to buy them. So they now have 100 shares as well. But those 100 shares used to belong to that person, and then you sold them and now they have them. And in theory, you could borrow those person's shares and sell them short as well. But that means you've just shorted the same 100 shares twice. The math works out because they have 100, you have a minus 100, they have 100 and minus 100. So overall it's flat, but I've shorted the same 100 shares 2 times. This isn't speculation. This isn't me being crazy. Go look it up. This is a real thing. So now you have the stock trading at $40 a share, and these companies are just hemorrhaging money on this trade. And what do they need to do to close their trades? They need to buy the stock. I mean, this is going to get ugly quickly. There is a building on fire, and the only way out is through a door that makes the fire worse. You got to buy to leave, pushing up the price. Buy to leave, pushing up the price. This phenomenon right here is called the short squeeze. And I don't think the world has ever seen a more perfectly executed short squeeze than what WallStreetBets and Redditors pulled off in early 2021. It took nearly 2 weeks for the short interest to reach less ridiculous levels. By the end of January, the short interest had come all the way down to about 50%. But all of that buying pressure to get there had pushed the stock to over $300 a share, sometimes popping over $400 a share. Our little mythical Wall Street hedge fund was now down somewhere between $600 to $800 million, chasing a trade that could only have made them $5 million to begin with. This trade was like picking up pennies in front of a steamroller. Or like this time, I taught my kids to ride their bikes down hills. The takeaway here is that short selling is dangerous, especially when lots of other people are also shorting the company, leaving the door open for a short squeeze. This is why Redditors and the WallStreetBets community tends to target companies like GameStop, AMC, BlackBerry, these companies with credible turnaround stories, high short interests, and low market caps. These are companies primed for short squeezes should the short interest get out of control. And one of the most fascinating things about this whole story is how WallStreetBets and the average Main Street trader has changed the face of institutional kind of Wall Street hedge fund investing. See, hedge funds are populated with super geniuses who have engines in them, highly motivated, highly intelligent people, and they are not built to wait around and hope their trades come through. No, they are actively leveraging their corporate platform and media relationships to affect the outcome that's of economic benefit to them. For example, Citron Research, a storied and famous Wall Street short seller, famously published this tweet: "Buyers at these levels are suckers in this poker game. Stock back to $20 fast. We understand short interest better than you and will explain." Now, Citron Research has later claimed that their account got hacked, but at the same time, this is still posted and available on Twitter, so that's gotta say something. But the point is, Until this GME phenomenon, it was common practice for Wall Street firms and institutions to announce their short positions quite publicly. They would use their corporate platform and media relationships to get their narrative out into the market. It was all just a way of making it public that they were short this company, which is bad news, which can actually itself push down the price of the shares. And then WallStreetBets came along and made them pay for being so public in their position on the company. This isn't the first time someone has run this playbook, but it is impressive that WallStreetBets identified the conditions and knew the tactics to carry this out so effectively. It reminds me of about 10 years ago when Bill Ackman very publicly announced a giant short position in Herbalife. It was a multi-level marketing scheme. He wanted the world to know about how this company was abusing people and all these bad things. But just knowing that Bill Ackman was short this company plummeted the shares by about 20% in very short order. But another famous billionaire, Icahn, struck back, recognizing that he could exploit this information to his advantage. Icahn actually started buying shares of Herbalife and got his voice behind the bullish narrative for the stock and pushed the stock 50% higher. This is a great tale of two billionaires who butted heads, and it was actually Icahn who won that particular battle in a very similar fashion to what WallStreetBets has done with hedge funds. The inefficiency that WallStreetBets took advantage of was the short sellers' own hubris and foolishness. When they took their short position and announced it to the world, WallStreetBets didn't follow. They got Icahn on the situation and recognized that these short sellers were shills for their own economic benefit and took the other side of the trade. It was less about buying a stock that they'd researched and knew was good, and more about going against a trade that they knew was bad. It was simply too public and too crowded to be good. So they took the opposite side. And whatever the fair price of the security was, doesn't matter. Because you gotta buy all the shares and more from the people who own it. And they weren't selling. And to put this in context, GME was a company worth just $250 million back in about June of 2020. That's 1/4 of $1 billion. As reported by this Business Insider article, it's estimated that the hedge funds shorting GameStop lost almost $20 billion on the trade. That is a massive movement of money from Wall Street firms into the pockets of retail everyday investors. A giant short squeeze executed perfectly. I'm Ryan Zathmary. See you next time.